Even if you never had to pay quarterly estimated taxes during your career, you may find yourself in retirement needing to pay quarterly estimates, and no one wants to do that. I've got a few ways that you can avoid paying estimates in retirement. I got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. No one likes paying estimates. No one does. When it comes to paying your taxes, most people think, okay, I pay my taxes when I file my return. No, if that were true, no one would ever withhold any taxes or pay in any estimates. I would say no withholdings on my paycheck at all. I would do my return in the spring, April 14th every year, and then I would pay everything that's due. And no, that's not allowed. The IRS says that the rule, what's required, is taxes are due when the income is earned throughout the year, okay? And so that's actually the rule, and you just true it up when you file your return. And if you don't pay in enough, you could pay a penalty even though you file. That's how all that works. Well, there's two ways that you can pay those taxes in while it's earned. One is through withholdings, okay? And those are withholdings from your paycheck, withholdings from your pension, withholdings from income, okay? And if you withhold, anything that is withheld is considered by the IRS as being paid on time, being paid timely. As long as you withhold at some point throughout the year on that income and you withhold enough taxes, then you've paid in timely. No problem. But the problem is you can't withhold taxes on all sources of income. If you have dividend income or interest income from the bank, maybe some pension account, something like that. If you own a small business, have rental income, you can't do withholdings on those. And therefore, how do you pay in timely when the income is earned? And that's that quarterly tax estimates. You might be familiar with that. And if you've run a small business or you had rental properties, you learned about this early on, and you got used to this unique rhythm, and it became a habit. So it caused, you had to remember to do it, but it sort of became, routine for you. And those quarterly payments, if they were only quarterly, and if they made sense, then that would help. But it's unusual. It's abnormal. The first quarterly estimate is due April 15. The second quarterly estimate is due June 15. In the second quarter, not even after, and not 3 months later, just 2 months later, June 15. The third quarterly estimate is due September 15, and then the fourth quarterly estimate is due January 15. So abnormal timing, and so catches people by surprise. Well, like I said, during your career, if you had a side hustle or if you had business income, you owned a business, had rental income, then you got the wake-up call. You learned about this and acclimated, adapted. But many people find themselves in retirement suddenly being told that they need to do and pay quarterly estimates, even though they never had to during their career. And this is at a time when you want your finances to be easy. You don't want to have to think about or adapt to this new schedule and remember. And then what if you forget? Now there's penalties, and it creates a lot of stress. So why in retirement do you all of a sudden have to start paying quarterly estimates? Well, because some of the income that you have in retirement doesn't have withholdings automatically set up. Think about it. In retirement, you might have more interest income from the bank where you've saved up again for retirement, and now you've got more interest and there's no withholdings on that. You might have saved up in a non-IRA or non-tax sheltered account that has dividends, okay, and now because you've retired, there's more in that account than you've ever had, so all of a sudden there's dividends. You might be selling some of those investments in your non-tax sheltered accounts to live on. That's creating capital gains or even capital gain distributions. You might, at that stage, early in retirement, you might have received an inheritance from your prior generation, from your folks that have passed away, and now all of a sudden you have some dollars outside of your tax shelter accounts that are creating some taxable income. It might be you've got a pension that doesn't have any withholdings or doesn't have the right amount of withholdings. And then, of course, I talk about all the time the frustration with taxation on Social Security and how they pretend that it's not taxable, but for more and more people, it is taxable, and they don't make it super convenient to set up withholdings to begin with. And so those are all the reasons why many retirees suddenly find themselves having to pay quarterly estimates and looking for a way out. Your CFP, working on all 6 areas of your financial life, specifically tax planning, but yes, present financial position, yes, retirement planning, yes, investment planning, should be able to give you some guidance and some suggestions on how to get around this. The problem is they're not going to if your tax preparer and your financial planner never collaborate. You might have this frustration, I've got to pay these estimates, and it might be due to how your investments are structured, and yet your financial advisor might not know, right? Your certified financial planner needs to be collaborating with the various financial professionals in your life so that your entire financial life is on one plan as opposed to having competing priorities. So that's comprehensive financial planning. That's what we preach about every time we're creating content for you. I haven't met anyone in retirement that wants to pay estimates. Some people just have to, okay? But if you can avoid it, if there's a strategy around it, we make these recommendations for folks all the time because people just want to avoid, dislike paying estimates. So what are some options that you should consider? 3 strategies for you. The first, and this is the go-to, this is the favorite. If you are in retirement and you've got your Social Security, maybe even a little bit of pension or maybe not, and then you're supplementing that Social Security, you're supplementing your retirement income with withdrawals from your IRA. Strategy number 1 is you over withhold on your IRA. You over withhold. You figure out, you do that proactive tax work to say, all right, how much taxable income am I going to have, and how much tax will the result be, okay? And then you look and say, yeah, but I'm not having any withholdings on my interest or dividends, capital gains, and I never set up tax withholding on my Social Security. So when all is said and done, we're going to have about $16,000 worth of tax. And so you take a look at your withholdings from your IRA and you make sure that you withhold enough from your IRA withdrawals to cover all the taxes that all of your income creates. And so this would be something like, well, we need $2,000 or $3,000 net from the IRA every month to make our cash flow work. And you look and say, well, but we need to have $16,000 paid in for taxes, so you withhold $1,400 and you gross up the amount that you're withdrawing from your IRA, and you withhold $1,400 and you receive a net of $2,000, and that makes everything work. Now, you're going to need to account for that gross up amount from your IRA. You're going to have to calculate that in your tax planning, but oftentimes people, instead of being subject to estimates, they withhold extra on their IRA. I gave the example where you can do this on a monthly withdrawal. You can even do it just once at a time, where you can look and say, all right, the total tax bill is going to be 16 grand. Let's withdraw 16 grand. We'll withhold it all to taxes. Now we're all set. Again, you do that throughout the year or at any time during the year, and it's going to count as on time versus having to pay quarterly estimates April, June, September, January. Second idea is, if Social Security is the culprit, you could actually give Social Security a call or fill out the form and mail it in to the Social Security Administration where you have taxes withheld on your Social Security. We do taxes for about 3,000 folks, and we do financial planning for somewhere near that number. I would say 25% of people that are drawing Social Security actually have taxes withheld from it. Maybe that number is even less. I don't believe it's more. It's rare for people to withhold taxes on their Social Security, and I'm okay with that. I like that, because not every year will your Social Security be taxable. But if you're in a situation where consistently, perpetually, you're having to pay tax on your Social Security, and that's causing you to be under withheld, and you might need to start doing quarterly estimates, set up withholding on your Social Security. It's not convenient. Work with your CFP on that. And then the final strategy, I've done some videos just on this strategy alone, but that is doing a 60-day withholding rollover. Okay, that's a mouthful. A 60-day withholding rollover, and this is how this works. if you were tracking with my first example where I said, okay, your taxes are 16 grand, let's pull 16 grand out of the IRA, just once, we'll withhold it all for taxes. Well, the issue with that, the problem with that is now that 16,000 that you just withdrew from the IRA and sent to Uncle Sam, now that 16,000 is added as taxable income. So if you're going to do that, you've got to do this circular calculation to make sure that you're withholding the right amount. But if your cash flow in retirement caused you to have, well, I've got the cash, I've got the extra cash that I've set aside and I can pay taxes, I just don't want to have to remember to pay it. How much do I owe this quarter? And then what about next quarter? And then the next quarter's 4 months away. How much do I owe there? But you've got the tax to pay the taxes, or you've got the cash to pay the taxes. Well, then you can do a withholding withdrawal from your IRA. Again, $16,000 if that's the right example, okay? And send $16,000 Uncle Sam. And then within 60 days, write a check from your bank account, the money that you've set aside and said, yeah, I was going to send this, I was going to pay my taxes with this anyway. Write a check and deposit that $16,000 back into your IRA within 60 days. That neutralizes, that offsets that $16,000 from being taxable. It's now a rollover, but you still had taxes withheld deemed on time from the IRS. A couple points to make here. You can only do one 60-day rollover once a year, and that's not once a calendar year, it's every 12 months. So you need to make sure if you do this in, let's say, November of this year, you can't do it in October of next year. You've got to wait at least 12 months. And then the other is you've got to make sure that you're not doing any other rollovers of, oh, I want to transfer the money from this IRA to this other IRA. You got to steer clear of that. There isn't one size fits all, but I will tell you, most people in retirement are going to be faced with having to pay estimates, and almost all of them do not want to. There's planning strategies around it, so work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.